Hey, what's up everybody? One of the biggest questions I get is how do you get started in real estate investment here in the state of California? So I wanted to do a few videos that kind of talked about how you get yourself going, what are the kind of strategies you could have to get into your first property, that kind of thing. So if you're ready, I'm ready. Let's go. So how do you get started in a state like California? Many states and real estate markets are significantly lower in price. According to Zillow, the median sales price of a home in California is $524,000. So if you're thinking about buying a rent-ready home with a 30-year mortgage, about a 3.25% interest rate and 5% down, you're going to be looking at a mortgage payment of about $2,400 per month. Also based on Zillow's data, the median rental list price is around $2,775 or $2.03 per square foot. So if you can find a 1,000+ square foot home for about $524,000, you're going to be breaking even after you pay for expenses like insurance and taxes and maintenance. So how can you get started investing in California? Let's talk through a couple of strategies that I think will make sense for your first investment. You'll want to be sure that your market can support your rental numbers. You'll also want to make sure that the local economy doesn't have any fluctuations during the year or cycles that it goes through where rent numbers can go up or down significantly. One way to tackle this is to buy a lower valued property that needs a little bit of work. You could target a property that's about $450,000 with about 2 bedrooms and 2 baths at minimum that just needs a little bit of work to be rent ready. So the repairs you're going to be looking to make are to replace carpet, new paint, updating your kitchens and baths, making any repairs to your electrical, plumbing, and HVAC systems, and also refreshing your landscaping. You'll want to try and cap your renovation cost to about $25,000. If you can do this, that'll give you a total investment of probably about $52,000 plus closing costs. One thing to note about this scenario is that with a 30-year fixed, you're going to need to live in the property for at least 12 months. The downside is that you won't be immediately collecting rent. The upside is that you'll be able to create a strategy to renovate your property, get it rented, and then also move into your next property, which I think will be beneficial for someone that's just starting out. One other strategy to employ would be to purchase either a duplex or a single family that has an accessory dwelling unit or an in-law unit. This could give you multiple benefits. One, you could actually live in the property. Two, you could also get an FHA loan if you live in the property. That gives you the ability to have a 3.5% down payment. One other benefit would be the fact that you could get a 203K loan from the FHA that would allow you to be able to roll any renovations right into your loan. So an example would be to get a duplex that costs $650,000 that has about $50,000 worth of renovations. So your total loan amount would be $700,000. So with a down payment of about 3.5% and with an interest rate that's probably around 3.5%, you're going to be looking at a monthly mortgage payment of about $4,284. In either scenario, whether you go with the single family or the multifamily approach, you're going to be in a great situation because you come in creating additional value by buying a lower valued property and doing your own renovations. An additional key to all this is ensuring that you don't buy the property with a tenant in place. Having a tenant can make it difficult for you to do your renovations. If the tenant has an underperforming lease, you won't get the rental numbers that you expected when you purchased the property. So if you're going to have the tenant move out, you'll want to set aside additional capital to help them move. And also you'll want to seek the services of an attorney to draw up an agreement that removes you of any liability. So if you've made it this far, you're now the proud owner of an investment property. The great thing about this is now you get to start doing your renovations. So hopefully you've thought about what you're going to do prior to the close of escrow. So that means that you've gone through the inspection process and had your inspection contingency removed by finding out all the things that you may have to take care of with the property. And it still matches up with the budget that you've set for renovations. So then the next thing is going to be to find how you're going to source your material, who your general contractor is going to be, if you're using a handyman, if you're going to be doing the work yourself. You need to lay all of these things out so that you can put together a plan that allows you to effectively and efficiently get through your renovations and then get ready to start renting the property out. And the other thing you want to do is you don't want to splurge on the renovations. You want to make sure that you do the right things to make it livable, but that's it. So if you're thinking about adding smart home capability to your property, only do that if it's going to make sense in terms of lowering your total cost of ownership on the property. If it's just the ability to say that you have smart home features in your home and it doesn't add any value to you in terms of your total cost of ownership, I wouldn't do it. So finally, you'll want to get it rented as soon as possible. That means marketing your property. So you'll want to get it on Craigslist with some photos to kind of let people see what they're going to be renting. Also, you'll want to try and see if you can find some low-cost rental sites where you can list your property as well. And then once you get a prospective tenant, you're going to want to screen. You want to screen heavily. You're going to want to screen their previous tenant history. So you're going to want to talk to the previous landlords. You'll also want to check out their employment history and their income. You want to make sure that they'll be able to give you the payment you need. In the state of California, it can be difficult to get a tenant out. So you want to make sure that you're doing your due diligence on the front end to make sure that you get a quality tenant that's going to make the rent payments on time, that won't leave you hanging with someone in your property that you can't get removed, and also having to make your mortgage payments without any rental income. So this is going to be very key. Also remember that you're going to be your own property manager. You're going to want to make sure that you keep very good records of payment history and tenant interaction. Because if there's anything that happens that causes you to have to remove your tenant, you've got all the information necessary to show that you held up your end of the deal as a landlord. In addition to payment history, you'll also want to make sure that you're saving your expense history as well. You'll want to make sure that you're saving money for maintenance and repairs and documenting those expenses. You'll also want to make sure that you're saving money for property taxes, and also save the money that you probably would have paid a property manager. That will be money that you can use to help get into your next property. The good thing about saving all of this information is that one, if you keep the tenant in place, if you sell the property, you'll be able to show how good of a tenant they are. Two, if you also have all of your expense history, it allows someone to be able to determine what their cap rate is going to be on the purchase of your property. This is also a thing that makes your property more marketable when you go to sell, because you'll be able to show exactly what the expense was and what the return was that you received on the property. After you get your tenant into the property, there are going to be a few things that you're going to want to monitor. First is going to be the market. You're going to be watching to see how your property value stacks up with other rental properties in the area. You'll want to see if it's appreciating in value to the point that you want to sell it at a premium. You're also going to want to make sure that your rental rates are in line with other properties that are in the neighborhood. The next thing you'll want to check are interest rates. Has the interest rate dropped below the interest rate that's currently on your mortgage? If so, it's time to refi. That's a great way to be able to get additional income just by refinancing your property and getting a lower mortgage payment. The next thing you'll want to do is start looking at the real estate market and trying to figure out what your second investment is going to be. You want to be ready by understanding what that next property is going to look like. So you'll want to start looking at whether or not you're getting another single family, or if you're getting a multifamily, what the cost is going to be, what the renovation cost might be, all of that. So you want to start preparing by looking at other properties in the markets that you're targeting, and making sure that you're ready to jump whenever there's a good deal out there. So that's why I talked about making sure that you're aware of what your appreciation or your value of your initial investment is. Also trying to make sure that you're getting any cost savings you can do by refinancing. So if you do all of those things, you set yourself up well to be able to move into your second property, or sell your first property and move into a move-up investment that's a bigger building with bigger rent potential. So the final thing here is going to be looking out for those time periods when you have rainy days. Hopefully we won't have another pandemic, but you also need to be thinking about vacancy. You also need to be thinking about time periods when a tenant may not have the ability to pay. So you may have to cover the mortgage during those times, and you need to have cash available to do so that you don't lose your investment. So it's very important that you start getting the profit that you get on your property and start saving some to help alleviate the strain that you may get when you don't have any rental income. In addition, you're also going to want to make sure that you have money set aside for any maintenance or repairs that you're going to need to do when a tenant moves out. You're going to want to make sure that you can get a place up and running and ready to go as soon as possible, as soon as that tenant vacates. So just make sure that you've allocated funds for that as well. The rainy days are important, but being able to get a property rent ready as soon as possible is also going to be important. Vacancy is your worst enemy. So if you find this information to be helpful, hit the like button. Also subscribe. I'm going to be doing more content just like this for new investors that are going to be looking to get their start in real estate. I know it's difficult to think about doing real estate investment during a time like this, but right now is the time to put together a sound strategy that will allow you to generate passive income for times just like this. But in the meantime, I want you to stay at home, stay safe, and I'll talk to you soon.